The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Welcome back to another episode of Fix It Friday edition of the Crazy Wealthy Podcast. Today, I'm going to talk about fixing something that quietly sabotages otherwise good decision making, especially during moments like this. It's called hindsight bias, or as I like to call it, I knew it all along-itis.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Why this crisis feels like one of the worst ever to so many people that I speak to. Right now, amid war with Iran and a spike in oil prices, I'm hearing the same refrain over and over again. This feels different. This feels worse. This might be the worst we've ever seen. Here's the truth. It isn't. That doesn't mean that it's easy. It doesn't mean that it's not painful. And it doesn't mean that it won't take some time to get resolved. But every crisis feels worse in real time than it looks later. Here's the reason why. Because uncertainty is painful. The rearview mirror problem is what we're facing. All past crises live safely in the rearview mirror. We know how they ended. We know how they were resolved. We know markets not only recovered, but went on, in almost every case, to new all-time highs. And the reason I say almost every case is because the current one hasn't done that yet. Every other crisis except the current one, the markets have recovered and gone on to new all-time highs. So they don't feel that bad anymore. But at the time, they felt just as uncertain, just as uncomfortable, and just as emotional as today's. Hindsight bias convinces us that we saw it coming, clarity existed, and the outcomes were obvious. But they weren't. I knew it all along isn't wisdom. When someone says, I knew this would happen, what they're really saying is, I'm forgetting how uncertain this felt before it happened. If we truly knew, we'd know when it would begin, we'd know how long it would last, and we know what would come next. But we don't. And that's okay, because successful investing has never required prediction. It requires preparedness, emotionally and financially. Preparedness, not prediction. Let's talk about what that actually means. There's emotional preparedness, which means investors must understand the true nature of markets, especially stocks. Since 1980, the S&P 500 has experienced average intra-year declines of about 15%. That means stock investors must be prepared to watch 15% of their portfolio's value appear to disappear every single year for any reason or no reason at all. Bear markets, which are declines of at least 20%, occur about once every 5 or 6 years historically, and have declined on average by about 33%. So successful long-term investors must be prepared every 5 years or so to watch a third of their stock portfolio's value appear to disappear, and to do so without altering their plan. I say appear to disappear because every single market decline again in history has fully recovered and has gone on to new all-time highs. As Charlie Munger, who's Warren Buffett's partner that has passed away in the last couple of years, put it, the first rule of compounding is to never interrupt it unnecessarily. Anytime we sell out of our stock portfolios because of anything other than the need for cash and liquidity, we are interrupting compounding unnecessarily and interfering with the likelihood of our financial goals being met. So what's financial preparedness now that we've talked about emotional preparedness? Emotional discipline only works when the financial structure supports it. That's why roughly 2 to 3 years before retirement, we advise investors to allocate 2 to 3 years worth of their spending needs into short-term bonds or money markets. This significantly reduces the probability that they'll have to sell stocks to fund their lifestyle needs while the markets are temporarily down. Why do we recommend 2 to 3 years of spending? Because since 1929, stocks have gone from a peak in their valuations to a trough. Say the average bear market is down 33%, and the recent peak in the S&P 500 was 7,000. So that means it would go roughly to 5,000 at trough levels, and then back to new highs above the 7,000 high in about 40 months on average. So if we have 2 to 3 years living expenses historically, that would have enabled us to have most of our money invested in what protects us against its biggest threat, which is inflation. So invested in stocks, and then have the 2 to 3 year spending set aside so that we wouldn't have to interfere with our stock investments during the temporary declines to support our living expenses. Preparedness, not prediction, is what protects long-term plans. So what actually works? Good investment plans have to assume uncertainty, discomfort, and periods that will occur where nothing seems to make sense. They don't rely on being right. They simply rely on being durable. Durable through volatility, durable through fear, and durable through not knowing. Because the defining characteristic of the future is this: there are no facts about it. Successful investors develop the ability to make rational decisions under constant conditions of uncertainty. So here's the fix. The next time your brain tells you, this is the worst crisis we've ever seen, and my financial situation is imperiled at a higher level than it's ever been, remind yourself of a few things. Every past crisis felt this way at the time you were going through it. The difference isn't the severity of this crisis, it's resolution. This one has not yet been resolved, and all the others have. You feel calmer about the past only because you know how it ended. The goal isn't to be right in hindsight. The goal is to have a plan that works before clarity ever arrives. So, in closing, I want to remind everyone that hindsight bias is simply this: an event that looked highly uncertain before it happened, but looks obvious only after it occurred. It creates the illusion that the world is predictable. But understanding the past never gives us the ability to predict the future. That illusion of understanding is dangerous. Real wisdom isn't saying I knew it all along. Real wisdom is saying I didn't know, and my plan didn't need me to. Fusion's behavioral framework exists for moments just like these, when emotion is high, perceived certainty is low, and disciplined decision-making matters most to protect and grow wealth. So I hope you enjoyed this episode of Fix It Friday. If you have friends who seem overly concerned about today's crisis, please feel free to share this podcast with them. You can always visit crazywealthypodcast.com and fusionfamilywealth.com to access the podcast and all previous ones. You can also find them at all your favorite podcast venues. Thanks for listening.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.